Welcome back to the Top Voices channel and our community talk series. My name is Sophia, and I'm so happy to introduce our guest today. Our guest is Grigory Chikishev, team lead quantitative trader at Quantum Brains. And today we have really interesting and exciting topic: AI trading using the tech without expecting easy wins. And I'm really looking forward for this webinar. It's very interesting for me as well. And let's get started. Please, Grigory, the stage is yours.
Today's topic called AI trading, expecting the tech without using the tech without expecting easy wins. My name is Grigory. I am team lead and system architect in fintech and specifically DeFi. I have 10 years experience in trading, blockchain tech, and last few years I focus on machine learning and artificial intelligence, so that's why we talk about today. Okay. We will discuss today the main problems which arise and how to overcome it in trading in my domain area. I will talk about my experience and my point of view, so you can disagree with me, but wait until the last slide and the questions area. Okay, let's start. Let's start with good news, like you open a newspaper during breakfast. In February 2025, Bloomberg reported that a company named Minotaur Capital literally beat the market, the AI hedge fund, which means that the algorithm is ruled by an artificial intelligence algorithm, had outdone the stock market by fantastic numbers. The company declared returns about 14%, while the global stock returned only 7% for 6 months. Pretty impressive, right? Usually, outperforming even for a simple 0.5% is huge. So you can imagine, not huge, but the success. And you can imagine how this news will be translated and how hyped it was. We can't really say that's is it working algorithm or not. Me personally, I think it's not a fake. Of course, there is some algorithm which works, but the headline is misleading. It implies that this algorithm will continue to be good, to perform well during the next 16, 60 months. But we do know that actually, and we have no proof of that. Looking just only on these numbers, I can help but remember the other story about fish. In 2022, YouTube blogger Michael Reeves released his goldfish named Frederick, into the water of stock markets. He constructed a special motion capture device, which determined how long the fish spent the rest of each day, in the left part of aquarium or in the right. And depending on that left or right, he every day he bought one share of some stock. For example, he chooses between Apple or Microsoft, or between McDonald's and Burger King. Then he compared his trading result with real people, not Warren Buffett, of course, but with some notorious group of Reddit traders named Wall Street Bets. And who do you think won? You see the slide? Yeah, the fish won. Fish profit was about 1,000 with a capital of 50,000, and Reddit lost 6,000. What conclusion can we make from this news? Does the fish beat market, or is the fish genius? Of course not. But yeah, goldfishes are smart, but not so smart. The amount of verifiable information in this story is the same as in Bloomberg article. Maybe even more, because you can repeat the experiment by yourself. You can buy yourself a fish, construct an aquarium, and buy stocks. Or deny that hypothesis, because the falsifiability is the standard evaluation of scientific theories, and the hypothesis, the term was coined by Karl Popper. We don't know really how fish thinks, but neither do we usually can interpret the way of neural network thinking also. But what we know for sure, that AI news usually gets more hype than fish. This slide is highly provocative. It contains word hype, bubble, but I don't declare that AI is a bubble. Sorry, not. Don't want to say that it has nothing in the base or it will explode like .com bubble, but the situation looks very similar. People use AI in everywhere for everything, and sometimes it's not useful, and sometimes it's really just dangerous. Let's talk about facts, because AI is mostly is a math, and math is a fact. And math was never be in any hype. Maybe only in ancient Egypt or Babylon. You may think that the main question is AI trading is possible? But even if you add the word profitable possibility, I can definitely answer the question by yes. Yes, it's possible. Yes, it can exist, but with some condition. With in some cases or in some time, there are always some conditions, and instead of answering that informal question, we will break it into the three more specific. And there are: what can machine do easily? So what are the easy tasks for AI or for machine learning? And what are the limitations and how we can overcome it? And how to verify our success? Let's start with the first one. Sorry, I can't skip this slide because it's basement for our future thoughts. I already told that AI is actually it's a pure math. Unlike the real brain or maybe quantum physics, it's fully determined. It's totally determined by a huge amount of pure formulas. When you finish this video and, for example, ask, is it true, Grok? There will be a billion numbers will be added, subtracted, multiplied, and divided. And the answer will 100% depend on how much information like that Grok has in its data bank. Yes, human brain works alike, but we hope there is a small place for some non-deterministic engine we call imagination, free will, whatever. But at that very current moment, AI has no imagination. It's only math. And AI is based on machine learning. Machine learning is based on statistics, and statistics is formulas. Maybe the very next year it will change and I will need to record a new video, maybe even with apologies to Grok. I hope not. So what are the easy tasks? We admit the math nature of AI and what tasks considered to be easy. For example, it's pattern recognition in images, in text. I mean, it's easy task to choose to say for the computer, is it a cat or is it a dog? Computer vision, sound waves, speech, anomaly detection. Yes, it's also a pattern recognition and quite an easy task. Yes, AI can detect the famous head and shoulders technical analysis figure, but we will talk later how useful it is. Classification also is a easy task. Also cats and dogs. Yeah, I like cats and I like dogs. These tasks is called to be perfectly labeled because every time we know the right answer, and without labels it will be difficult to learn the model, to teach the model. Not impossible, but difficult. And the second class of tasks, which are easy, are the tasks when you have really much data. Most of modern ML algorithm existed in 80s or 90s, but they didn't work at all because there were no enough data to teach them until until internet has arisen. And dealing with the data, with such amount of big data, is where AI is good. When you use LLM, large language model, for answering your question, the answer usually be a generalization or aggregation of all amount of data the model saw before. So it's only so it's statistics too in some kind. Yes, during the conversation, your chat GPT can change its mind and said, "Oh, you're right. The answer is totally opposite." But it's also in the data. And so from this point, we can formulate what is hard for AI. And the hard tasks are the opposite of easy. Mostly the reason is the absence of clear data, of much clear data. The first problem we will talk called signal to noise ratio. Markets, trading markets usually are full of noises. Someone says it's chaotic, but chaos is also a system. Market price and order book can follow some dynamics, of course, but it contain a lot of noise. There are some econometrics rules like autocorrelation, but it often works not as you expected. For example, if today is a highly volatile day, like Trump tweets something once more, the volatility spikes the price of the magnitude of price variance. And you can expect that in 1 hour the volatility will be as high as now. So it's correlated with the past values. But the price direction itself has no such correlation. If today we see the prices are high, then tomorrow it's 50-50. Not, of course, every day, but in generally speaking. Real prices are highly affected of actions by thousands or millions actors, trader or real traders or algorithms. Some factors, some are known, some are hidden. And the main problem is finding a stable signal here. Because because the signal is very weak compared with the amount of noise, and it's not an easy as pattern recognition because the signal is really overwhelmed by noise. There can be no pattern whatsoever, but the machine learning model will try to find some and will totally end with some model, even if it works with fully random data. Because every machine learning is basically it's a cycle with end conditions. So how can we help the model to in that case? I will talk about simple solutions, not universal, and not every solution we will talk about. First of all, what can we do? We can average. So the best way of dealing with noise is average or aggregating data. For example, you can calculate so-called mid price, the price between ask and bid, in many ways. Instead of asking what will Apple stock price will be 1 second from now, you can ask what it will cost to buy one share or 1 million shares. In the second case, we predict the average price for a large volume, and it much more stable in time series terms and better reflect the market movement. On the picture here, you see the average price for Bitcoin on the Binance exchange, weighted by 3 different volumes. The black one is simple mid price with $1. Green is 500 and red is 50 millions. So I think it's obvious that RenWAD looks more smooth, less noisy, and with such data, your algorithms will learn better. I can't say it will learn something, but it will be better. The second way of averaging is working with prediction target. When you predict some price, you can say, let's predict the exact price that will be in 10 seconds. But this value is random too. More robust one is let's predict volume weighted average price for the next 10 seconds. And this solves two problems at once. Firstly, if the price jumps, like you see in the center of the picture, if this price jump occurs within those 10 seconds, the exact movement doesn't matter so much because averaging smooth it, and the algorithm therefore has fewer, less ways to fail. And secondly, this averaging also reduces the average penalty your algorithm will gain during learning. Here will be a small mathematics. In simplest case, called regression model, your algorithm, your model tries to lower the sum of penalties, which are proportional to square difference between the real prediction, between the model prediction and the real price. The larger the error, the quadratically higher the penalty. And without such filter, as we see here on red filter, I'm pretty sure that your model will learn to predict zero, so no price movement, because it will be, how to say, afraid of mistakes, like a small child. By changing the target, we essentially relabel the data and provide more clear way for the right answer. So yes, this is the factor is relabeling. This makes prediction problem close to an easy task, as we discussed earlier. So yes, on the picture here, example of smoothing on 10 seconds. It's a red line. It looks like smoothing like medium price, but I but now we work with target, so it's a slightly different case. Second problem is simple. Even in trading, you may have not enough data. For example, you want to prepare a model for 1 year data. If you count one price every second, you will get eventually on less than 10 million tokens. In big data terms, that's nothing actually. Well, it's good for a school project or some pet project, but if you're a huge hedge fund, that's not enough. Your model will be small and will learn to nothing, actually nothing. So how can we solve it? First one is statistic. Yes, AI statistics still. Statistic method called bootstrapping. Suppose you have 100 observation and you want 1000. You repeatedly take random subsets, it's called samples, for example, 50 items each, and you can get and compute the needed statistics, for example, variance or expected value from them, from that small distribution. The number of possible choices, 50 out of 100, is quite large. So all sets will be different, and you can get hundreds or thousands of smaller data sets and more reliable estimation when you average it over that resample set. This method lies in many backtesting strategies. Backtesting or simulation, it's a process when you use local market data, not real time, for trading, for tuning algorithm, or teaching your model to make a right decision by yourself. And it looks like it may remind you of Jesus, who have 5 breads and 2 fishes, not goldfishes, sorry, Frederick, to feed the crowd. Here is the same. Next one is data augmentation, of data changing method. It's a dangerous one, and I will tell you why. For image data set, it's simple. Like you have image of a cat, and you can stretch it, distort, rotate, and you can get new images, and you can get a big data set of cat images. With finance, it's harder, but this trick still works. Time series needs more delicate approach, because it's very important not to mess with data and not to learn some information from future, because that's what you want to predict. Therefore, like just swapping some cases, some parts of time series is not recommended. On the left bottom picture, you see the example of permutation augmentation, which I will not recommend. You see the green lines swapped on the second and third part of the picture. But the other cases are fine. You can scale or you can stretch the not the picture itself, but the time series, and therefore gets more data for learning. Um, well, suppose you manage to overcome some difficulties and get a model which beats the market, or at least in a backtest. How to verify its result? That's actually the most important question. Sadly, we are still far from result here. Getting good training metrics is actually very easy. If your model will be too sophisticated, for example, I don't know, a million layers in your neural network or million neurons, it can learn all the data you can have precisely. So it will struggle with new and real life data. It's called overfit. The good news is that it's easy to check because machine learning has a big history of dealing with the overfit. For example, you can leave some fresh data for validation, not to never use it for learning. But in real trading, you can suffer even from so-called luck, even for a long period of time in real trading. And now you can recall the Minotaur Capital case. Just because trading involves a million of participants, somebody will be lucky eventually. There is no way actually to distinguish between a lucky guess and the true choices of if you look only on trades. For example, buy, sell, buy. You can say if it's random luck or is it a right decision for an algorithm. The example is on the screen. If you take 1,000 people, one will be lucky enough to get 10 out of 10 right guesses. So, what is the best move for him on 11th day? Sometimes such people are smart enough to stop guessing and start selling webinars. I'm not so lucky enough. So now we can say exactly what AI is useful for actually. The algorithms we discussed, which have the algorithms for easy tasks, you can rely on them. For example, sentiment analysis. Just parse Twitter, x.com, extract some words, average metrics. The modern LLMs are really good for it, actually. Next one is finding a hidden arbitrage in arbitrage opportunity. For example, in it's our cases in decentralized finance in blockchain, there are millions, really millions of tokens. Each one can be traded against each other, and you can find the chain of deals which will be profitable for you. It's a hard task for a human, of course, but it's really easy task for just for brute force searching. With AI, you can your AI agent may have mistakes, but it's easy to check the profitability of such a chain before the deal. So you can use AI here too. And market making. Market making is also mostly about dealing with statistics and determined models. For example, if you have bought some assets on exchange A, then you can decide if you need to hedge on exchange B, or you should keep the asset. I'm not talking about price prediction. This is a hard problem. See you later. I'm talking about market making price dynamics, which is more suitable for data analysis. What are the hard problems? Mostly it's about prediction, yes. And any kind of directional trading, long-term predictions, they are really hard tasks for machine learning and therefore for AI. And also by the reasons we discussed before. And the technical or fundamental analysis is also not an easy task because mostly because of lack of data. Usually, the professional trader use their brains to analyze some market dynamics, but as we say, sometimes it's hard to distinguish luck from real professionals. And speaking of risks, very rare events called black swans, the term by Nasib Taleb, are especially hard for learning in models. We have them maybe even more often than to call it rare, but nevertheless you literally can't predict something which occurs maybe one time per 10 years. No model can predict that. Model can predict an anomaly. You can think of it like a meteorite which can fall at you with non-zero probability. The main problem is that such event will end your experiment. For trading, dealing with such events, it's a risk control task. You can delegate it to AI agent, which will try to find the anomaly. But unfortunately, just like the fencing from the meteorite, unfortunately, it will detect the anomaly, but maybe it will be too late. You will only know for sure only after it happens. So, to sum it up, AI is a great tool, of course, but as any tool, more important how to use it, how to deal with it. If you are using language model for trading, I would say you're really wrong. Even if you will make 1,000 of good trades, the next one can end your experiment because it's like a random walk process where eventually you can find yourself a bankrupt because you can profit unlimited a number of persons, but you can lose only 100%. Let's end on the positive note. I think the main problem of AI, the main flaw, it's math nature, but actually it's an invention too, because algorithmic trading, generally speaking, is emotionless, and the emotion may be even more dangerous in finance than AI. But I think this will be a headline for the next video. I hope you have positive emotion after that one. Thank you for watching. So if you have any questions, let's discuss them. Yeah, I see question. How to augment data in a market with low event frequency? Yeah, for example, it's the case I described. If you have no high frequency data, high frequency means you can sample prices once 100 times per second. You have only like 1 minute candles. Your connection is bad, so I will continue. So what to do? Well, actually, if you have really small amount of data, I think nothing you can do here. But the good news are that nobody has. So, for example, if you come to some exchange and will sample only 1 minute candles, but there is a way to get more precise data, like high frequency data, then someone who gets it will have advantage. So what I'm trying to say, if there is no way to get more data, more precise data, then every trader is in equal position. And well, I will not recommend using that augmentation for really small subsets, like less than 1,000 maybe tokens, but for 10 or 100,000 augmentation is fine. How you can resample, for example, you can drive your own price dynamics from distribution. There are a few models like Markov chain models when you have the current prices and you will try to emulate the next price for some synthetic assets with some rules. I don't know how to answer it shortly, but you can Google like Markov model, Markov models for that. Next question. Is it worth building AI trading tools in-house or better to use existing platforms? Well, to be honest, I never use an existing platform. The only platform I use is our own, but I can recommend to develop it at home. Well, I will recommend it to learn something new, to see how it works. But I really can give an advice for you to use your own algorithms to make profits. Using some foreign algorithms or platforms, sometimes they are just black boxed and you don't know how they work. And it's like asking an oracle, should I buy that stock or that stock? So it's like using a fish again. So better use your own algorithms. At least your mistakes will be yours and yours only. What should team skill and what should team skill and an AI trading initiative? I don't really understand the question. What AI trading initiative is bad? Like I said, using ChatGPT for trading is not a good idea because ChatGPT it's a large language model, so it uses amount of data, mostly text, and produces text. If you ask them to analyze some maybe tables or data, it also use texts. The modern engines can work with and can learn on different data, but they're not trained on real market data because the market data just don't lies in internet everywhere. But what you can find in internet is speculations and charts. Recently, I saw a story about a guy who made an experiment with ChatGPT, he somehow he controls his portfolio with the ChatGPT making processes, and he had very good chart. He every week he posted a report, and his profits looks like that. Well, if you see my arm, so it will rise and rise, rise and rise until the start of November, when the profit drops and he lost everything, and not everything, but he loses about 200%. Then the reports stopped to be published. So it's a lesson I think everyone should be avoided. That's a lesson you better to learn on other mistakes than yours. Can low data environment like crypto still benefits from machine learning models? Well, actually, maybe I have a vague formulaic, vague phrase. Modern crypto is not low data. Actually, it's rich of data, but it's specific one. You can see on if you compare, for example, market data on CME for Bitcoin futures and Binance perpetual futures, the amount of data on Binance will be larger. And there are updates, I think, every 10 or even 5 milliseconds. So it's about 200 updates every second. It's a lot, and that is called high frequency data. In decentralized finance, there are less data because many transactions are off chain, and you can't analyze them until they get into the blocks. I mean, you can analyze what not was included in the block, and main information is lost. So if you want to trade on some DeFi, you need to look at on-chain data, not only on-chain data, but the off-chain too. It's real-time data. You should run your own node, I think, or yeah, it's better to run your own and scan every transaction or L2 which runs into web. What are common red flags in AI trading desk or pitches? Well, I think the main red flag is using, like in any technology, is using just buzzwords, not using technology at all. So if you say if you see any using of AI where AI is not useful, that's a red flag. Like I said before, wrong using tools, wrong tools for the wrong tasks is the common mistake, and some people think that it's okay. They think of it right until the first failure. Again, red flags. What are the sign your AI model just lucky, not skilled? Well, it's called verification. Verification is a hard process. If you have unlimited data, it's easy. You can put away unlimited amount of validation data, but in real life, it's not easy. And if you use many data for training, for example, 10 years of trading Bitcoin, you can use outdated information. For example, markets 10 years ago were absolutely different than it's nowadays. and you can only use the fresh modern data for learning. And in that case, the amount of data is small and you can overfit. The simple process of checking if you overfit is run your algorithms on the same data after you use it on the production. So, for example, you trade today from with your model, and it, let's say, it sucks. Just wait one day, put your data in backtest, and run your algorithms there. So if it will fail again in backtest, then that's how your model will train to do. But if your test will be good, better than production, then the problem is not in the model itself, not in backtesting, it's in your product. And there are the other side when your model is lucky, I mean, it's profitable on the production, you must repeat the same process tomorrow. Because if it will not um, show the same results on in backtesting, then there are some problems. Mm,
Okay,
Well, I
I
don't
think
see
that
any other question.
no, and I cannot see other question as well. Thank you very much. I hope that our audience receive very deep and very important and useful information for them. And thank you very much for joining us today, Grigory. And please feel free to contact him on LinkedIn to keep talking and subscribe to the Top Voices newsletter and follow us on LinkedIn to stay updated on our new events because our speakers and guests were from different fields, and we are so happy that our audience can catch this knowledges from you. Thank you very much, Grigori, for joining us today again, and thank you. We hope to see you next time.
Thank you for inviting. Have a good day, everyone. Cheers.
Thank you very much. Sorry for technical problems. Thank you.